about I came to Old Capital about 8 years ago. And when I thought, hey, I needed a team. The banks kept saying, go away, get a team. And I thought, I don't want anybody on my team. And they said, well, until you mass more wealth or you have more cash flow in your bank account, I can't do anything for you. So I got educated. I had done so many deals, so many mortgages on the single family side. I was welcomed into commercial. And really, I'm an asset here because a lot of lenders come out of college and they do not have any experience. So I look at things a little bit differently. And Old Capital has been in business, as I mentioned, 38 years. We've closed over 8,000 loans. So when you've got hard money on the line, you got to make sure that your lender is going to be able to close for you. In Texas is where we started. We close 1 in every 3 loans. So we're very big in Texas, but we do go nationwide. We are specialists in multifamily, but we will go to the other asset classes in commercial real estate. So a couple things that I wanted to share with you is we are all about education. You go to education programs, you know some that I talk about, but we do a conference, the Old Capital Conference. We do it yearly, and it's not about selling a program. It's really educating you. So come join us. It's October 9th and 10th in Dallas. This is where you will find the top-notch brokers, investors, sponsors, syndicators. They're all there. So I highly recommend it. If you've not connected with the Old Capital podcast, again, huge asset to have for our company, but also for you. 60,000 downloads a month. It's the place to go to figure out what's really happening in the market, not only from a lending side, but what we're seeing because of our relationship. So we share a lot of information there. And then lastly, Zoom at 8. If you're not familiar with Zoom at 8, it's a platform similar to this. We bring in industry experts every Tuesday night, 8 p.m. Eastern, and we network and learn for an hour and a half. And we've been doing it for 5 years. It's the longest standing platform in commercial real estate. So would love it if you guys could come join us. Go to dancinginvestments.com. All right. Where are we at, Winston?
I hadn't gotten, I sent you a chat with my email. I'm not sure if it was typed in wrong. Everyone spells my name wrong, so I wouldn't imagine the difference. But
oh, it did come on deliverable. Okay.
What we can do if you don't go ahead.
I just try to say multiple participants. Can you try it again?
Okay, let me share. Oh, there it's coming. Thank you.
Perfect. Thank you, Kim.
All right.
And guys, we're gonna do a hard stop at 11. Julie actually has a meetup. She does yoga for her meetup, which is awesome. So if you have any questions, go ahead and throw it in the chat. This isn't a wait to the end type of thing. Quite honestly, with my ADHD, I wouldn't even be able to remember the questions. So, we'll make sure to bring them up as we're going.
Okay, so what's your screen show? It's the full?
We see you in the power check. Yep.
Perfect, thank you. So whether you guys are looking to be a passive or an active investor, so that's an LP or a GP, what do you need to know about lending? And so we're going to go over that today. First of all, you need to figure out where is the best place to invest, where to put your money. Now, we've seen a huge absorption of assets delivered to the Sun Belt states. Why? Because everybody jumped into multifamily over a 3-year period and they could not find assets. The big guys were buying them all up. They said, well, what can I do here? They went and bought land and developed. And these are now being delivered to the market. It took them 3 years. This is the largest delivery. You see the yellow? That's where we're seeing, or it's orange. That's where we're seeing a lot of rent decreases or even at zero. So if you're thinking about what markets, look up into the Midwest. These are fantastic. There wasn't any deliveries. Why? Because everybody was focused on the Sun Belts. So look in your Omaha, Nebraskas, look in Chicago. Although I'm from Chicago. I don't like the politics there. There's a lot of crime. You got Michigan, Wisconsin, Madison, Kansas City, top markets. I highly recommend you think about those. And everybody's complaining about the interest rate. But if you've been in this for a very long time, my first house I bought at 13%. These are low for us. If you look at the standard, where we've been over the years, we're really right in the average. So for you new people, you're going to hear a lot of complaining, but there's not a lot to complain about other than people jumped into bridge lending and they bought at a high, and now the rates have spiraled up, and it's a disaster. So let's find out what kind of loans are out there. What we're going to focus on today is multifamily lending. Now, the other assets classes would use bank, they would use bridge, but the other asset classes do not use agency. And what is agency? It's Fannie and Freddie. Fannie and Freddie are government entities that say, we want to support the American people. We want to provide housing. So this is the gold standard, and I'm going to take you through how do we, what are the guidelines and how do we get into these deals? How can I be part of them? So first and foremost, recourse versus non-recourse. Winston, if you could check and see how many people, if you could put in the chat, how many people with a yes or no know both what a recourse is and non-recourse. Recourse versus non-recourse. I want to make sure I go deep into this if it's something that you need. Yes, I know both. No, I don't. Quick. What do you got, Winston? You're on mute.
I don't have a. Oh, there we go. We got a yes. Fair idea of both, but would love a deep dive. So I think
Okay.
general consensus. Let's dive.
All right, let's go. So when you buy a house, you're looking in the lender is looking in your shorts. I like to say they're looking at your tax returns. They're looking at your W-2s. They're looking at your bank statements. They're getting into your credit. They're doing everything to find out all about you. That's called recourse. If you default on your house and you cannot pay the difference, you walk away, but they put a scar on your balance sheet, on your credit score, right? Same thing applies in multifamily, in commercial real estate. So you call me up and you say, hey, I want a loan. And I say, well, we're going to need to qualify. On a recourse loan in commercial, you're going to need a credit score, 600 or more. You're going to know bankruptcy. You're going to need your tax returns. Well, remember, you're buying a business in commercial real estate. So we're going to attach your house, your kids' credit, your kids' college tuition. All of your assets will be tied to this commercial building. If you default and you have 2 or 3 or 4 partners, you're all 100% liable for that default. That means if you default by $3 million, each one of you will need to come up with $3 million. If I'm thinking about how my tenants are paying and relying on them to help me pay my bills, recourse can be a challenge. So a lot of syndicators will say, I'm not interested in recourse. Although a lot of new people get into recourse because it's easier. It's easier from a position where you don't need the guidelines that agency, which we'll go over. As opposed to non-recourse, while you're going to sign on the loan like you are on recourse, you're going to say, I'm going to do everything in my power not to default. If you have bad boy behavior, then we're going to change that non-recourse to recourse. But I'm not going to tie the success of this business to any of your personal assets. We're going to go in with an LLC. You still go in with an LLC on the recourse, but the recourse is going to be tied to the person. where the non-recourse is not. Okay, we are still going to pull your credit. We're still going to see if you have a bankruptcy. We're still going to see what your FICO score is. But if you default without doing bad behavior, you walk away. Now, is Fannie going to say, hey, let's do some more business? Probably not. What we would do in that case is we'd go to Freddie. So it gives you some options if something bad happens. And there are a lot of bad players right now in the market. So you got to be careful who you are partnering with. All right. So get a piece of paper out, because this is the gold standard. The 4 requirements you need for agency. That sounds like a YouTube channel. All right. First and foremost is 90% occupied for 90 days. Now you're going to talk to brokers, right? And if you're a passive investor, this is going to give you an understanding of what the general partner had to do in order to qualify. 90% occupied for at least 1 month, because it's going to take us 60 days to close. So we get into this deal for 1 month, then we take 60 days, that's 90 for 90. Now here's the problem. If we're going for smaller deals and the occupancy drops, Fannie's leaving. They're like, see you later. So that's why you want to make sure that you have all of these qualifications on top of mind, so you don't lose that money. The other thing is when you talk to brokers, tell them, I only want agency financing. I love the non-recourse. So tell them, don't show me the less than 90% occupied. All right, net worth. That's your assets minus your liabilities. I'd be curious, who in the room, you don't have to answer this, but has a personal financial statement and schedule of real estate owned form filled out? If you want one, please email me. All right. I can send one to you, because here's the deal. You have to know what your roadmap is. Who are the partners that you need? They are the ones that are going to help you with these guidelines. So when we're talking about net worth, we need it to be equal or greater to the loan amount. And I'm going to give you an example. So just these are the guidelines, and then we'll apply it. Third thing, liquidity. That means cash in the bank that's going to sit there. We call it post-close liquidity. We need 10% of the loan amount sitting in a bank account. Now, it could be all of your partners. Remember, the more partners you have, the less everybody gets along, let's say, right? Harder to make decisions. Didn't your mother say to you when you were about 4 years old, we'll have one friend over, but when we get a bunch of boys and girls together, nobody can make good decisions? It's the same thing in multifamily. So in liquidity, everybody is going to put their money and show me a bank statement, how much money you have in the bank. All right, that sits there. Now, the thing that people fail to realize is, as the general partner, you also need to put money in the deal. You need to bring 5 to 10% of the equity. Remember, I'm bringing the debt. There's also the equity piece, and we'll unpack that for a minute. But I need 5 to 10% coming from your group. All right. And then last thing, and this is kind of the challenge in these times, is experience. Experience is one asset in multifamily and held for 2 years. Now, if you come from single family and you're like, I'm done with single family, and I own 10 single family doors. Now, when I say single family, that's single family residential lending. That's going to be your 1 to 4 units. If you have 10 of them, you now qualify as a sponsor. Yes, you heard that right. So if you have more than 10, or you have 10, but not less than 10, you've held them for 2 years, you need to come see me, because I've got some business to give to you. So find those people who have the experience. Okay. So let's go through this example. Really helpful. $10 million deal. You've got, let me tell you this. You're looking at this asset. You say, everything works. I've got the right returns for my investors. $10 million deal. You need to come to me first before you put in an LOI. Why? Because I might not be able to get you 70% loan to value. It may only be 50. So you may be overpaying. Big tip there. Pro tip, as they say. Go to your lender before you put in an LOI. Seriously. We've had too many guys go in and say, I'm going to pay 6 million. And the lender comes in and says, 5 million is what you should be paying because I can't get you a loan that returns what you need for your investors. So again, $10 million deal, I'm bringing 70. Now in today's market, we're really underwriting 65 to 70. And I would encourage you to do that. I was on a webinar yesterday with another educator and he was saying, put in there 80%. We haven't done an 80% deal in probably 3 or 4 years. It's that way. So I'm bringing 7 million, which is 70% of the 10 million, right? You're going to need 7 million. Remember, it's equal to or greater of the loan amount. So $7 million in net worth. Who has 7 million net worth in the house? Anybody? Well, then I want to talk to you. 700,000 needs to be in the bank. Who's got 700,000 sitting in a bank, not making much interest rates? That's what I'm going to need for this example. You're going to need to have multifamily experience, not necessarily Fannie and Freddie, but if you have bank and you've had it for 2 years, or you have the single family we talked about, that would check the box for experience. And then on the equity, as I mentioned, I'm bringing 7 million, you would bring 3, and I need 5 to 10%. Can you do these deals without any money? That's my question. You're going to need to find somebody that has money if you're not putting in the deal. Now, listen, if you're a capital raiser and somebody says, how much money are you putting in the deal? And you say no, why would somebody want to invest in that deal? So get some capital. So let's unpack this. Agency financing starts at $1 million. These loans are 5-year, 7, 10, 12. They're fixed. We run on the treasuries. The treasury, if you look up the 10-year treasury, it's been all over the place. Right now it's about 425. And then we add a spread. That's how the banks get paid. So the spread can be anywhere from 160 to 300. So I actually would be underwriting any deal that you're underwriting today at 425, or go pull up Google and see what a 10-year treasury is and add 250. Okay. You're going to, again, I told you 75 to 80 is what in a good market we can get to, but don't underwrite it to that. 65 to 70 is a great way. I'll give you more if I can. You're going to underwrite these at 125 debt service, but depending on the area, if you go to a tertiary market, my lenders are going to be like, that's real risky. I need you to bring in a little more money into your mortgage. Interest only is a big deal, guys. You can do a full term interest only loan, whether it's 5 years, 7, 10, or 12 years, full interest only. You got all this capital coming in. You can give that over to your investors. A great way to think about doing these deals. That would require a higher debt service, about 155. Amortization is 30 years. So we're amortizing the mortgage payment over 30 years, but these are balloon payments. So you're only going to hold it for 5 years, 7 or 10 or 12. At that point, you have to refinance and you get out. Either you sell it, you get another loan. It'll cost you 1%. So make sure you put that into your closing costs. And then there's this thing called step down and yield maintenance. And we're going to go into this because I think it's very important. Most people don't understand this. So I'm going to.
Real quick, Julie.
Yeah.
Sorry to interrupt. I got Joey put in here. Is DSCR qualifier in place only?
So it's really going to look at your T3, and yes, it's going to be in place, but we're also going to look at your expenses. So if the expenses are high in place, we will look at your estimated, and we would also ask an appraiser. This is in place. This is Joey's, and this is the bank's, and they have to be as close as possible. So we're gonna say, well, your insurance looks a little low. We're gonna put it at ours, but your property management may be high, and then we're gonna come back and say, is it really gonna be 10% to manage this? If it is, then we're gonna go do your 10%. So I would say it's not really in place, but it's in place on the revenue side. Okay. And when you are underwriting these deals, big thing to look at is your T3 income. That's your net rental income. How do we get to that? You have your income minus your bad debt, collections, right? And loss to lease. That's your net rental income. Then you put in your other income. That's T12. Another pro tip, really important. Then you get your EGI. That's what the bank is going to use as your income. So don't forget that. A lot of people use T12. So any other questions?
Yeah, I got a direct message. Is there a general rule of thumb to use for interest only in underwriting?
Yes, good question. So this is how I would underwrite it. On a 5-year loan, I do 1, 7-2, 10-3, 12-3. Here's what I've seen. 5-2, 7-3, 10-3-5, and 12-5. But don't underwrite it with the most, looking into the future. Look at kind of that as a guideline. Okay. Anything else?
That's it. Thank you.
Perfect. So yield maintenance and step down prepayment are the only ways to get out of agency unless you hold the loan all the way up until 90 days before close. All right. So why do you choose these prepayment penalties? It's not like single family where you buy it on a Thursday and you sell it on a Friday. You are going to be dealt a prepayment penalty. So yield maintenance goes like this. Today's rate is 625. I said, yeah, today's rate 625. We close. I say, what is your plan? Your plan is to hold this for 10 years. I sell you that at 625. But in year 5, you call me up and say, we're ready to sell. What's my prepayment penalty? I call up my capital markets and they say, well, today's rates are 8%. So it's gone up. The bank loves that because they can deploy their capital that is in your deal at 8%. So your yield maintenance, you'll still be assessed a yield maintenance penalty, but it will not be that bad. However, if we're at 625 today and it goes down to 4, Mr. Banker is going to come in and kind of spank you and say, hey, dude, you told me 10 years. Now I have to deploy my capital at 4. That's not good for you. It's not good for the bank. So what they need to do is become whole, be made whole, and that could be $2 million. So today you don't know how to underwrite that. Now, 5 years ago, we did it all day long because the rates were not changing at all from a day to a minute like they are today. So a lot of people are doing step down prepay. So a yield maintenance is on a 10-year is your cheapest debt. Okay. When we go to step down, it's going to add between 10 and 80 basis points, depending if you're going to from Freddie or Fannie product. So let me unpack this. So we have a 10-year loan, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. A step down would look like this. In year 1, if you needed to get out, it will cost you 5% of the loan amount. In the second year, 5%. Third year, 4, 4, 3, 3, 2, 2, 1, 1. Got it? So if we needed to get out in year 7, because you come back to me and you say, how much is it going to cost me? Here's year 7. What's it going to cost? 5, 5, 4, 4, 3, 3, 2. 2%. So if you know, hey, I'm going to be in this for 10 years, I may want to get out, step down as your way. Because then you can underwrite and you can show your investors before they sign on your PPM, I may get out and it's going to cost me 2%. That is awesome. Now there's all different levels of ways to get out of these. You can do 333, 222, 1111. That's going to cost a little more. It's like going to In-N-Out or McDonald's. It's all different ways to slice the menu, right? You can add onions, you can, put salt on your fries. All of that is applicable to financing. So that is how the prepayment penalty goes. So if you want to get out with, no high penalty or knowing what your penalty is, your step down is going to cost you, like I mentioned, 10 to 80 basis points. So we talked about agency. There's also assumptions that are happening right now. And you have to be careful with them because not all assumptions are made equally. You got to be careful because if you see one, and I see a lot of them, they're at 375 because somebody bought during COVID and there's only a small amount of time left. Well, if you're thinking about holding this for 10 years and you're in 3 years left, how do you underwrite that? Because we don't know what's going to happen with agency loans in 3 years. So you need to blend what is happening in today's rates with what the assumption is. That's not an easy and accurate way to do it. But if there is enough time left on the loan, an assumption is a great option. Okay. You want to be careful that when you are looking at the cap rate for that area, you never want to go into a negative cap rate. Okay. Because what happens is negative leverage. I should say negative leverage, because if the cap rate is higher than the interest rate, that's called negative leverage. That's a bad place to be. Okay. The next option you would have is a fixed bridge. Fixed bridge is awesome. I absolutely love it. Think about this. You're going to buy that $10 million loan, that $10 million deal. I'm going to bring 75% of that purchase price. Remember, in agency, it was 70. I'm going to give you 75. And by the way, if you want to renovate those properties, this is why you would use this solution. You're going to add another $1 million in CapEx. If you were doing it on agency, you'd have to capital raise that. You'd have to pay money for that money to come in. And you'd be paying maybe 8, 9, 10% equal, but it's really hard to find money right now from investors. So fixed bridge is awesome. If I were to say, I'm going to give you 7.5 on your loan, and I'm also going to give you 100% of that CapEx. Now I'm giving you $8.5 million for your $10 million loan. You only have to bring in a small amount of money. Okay, so this is a great option. We start these at 500,000. However, there's always a caveat. It's costly. On the agency, we're at 625. They can go down to 599, 575, depending on how large your asset is, all the way up to, I'm seeing some in the 7s. Fixed bridge starts around 775, 875. I would underwrite a fixed bridge at probably 10%. Okay. These are 2 or 3 year loans, interest only. Okay. And you only pay on the capital that you have used to improve it. So you would do a draw after you improve it and they repay you. Okay. You also have the ability to extend it. So you're in a 2-year loan, you extend it. Hey, I need some more time. We'll extend it for 3 years. After 3 years, hey, I need to extend it. We extended to 4 years. So a 2-year can become 4, a 3 can become 5. So it's very cool. You have to be in these for at least six months. To get out is 0. We're going to front load it at 1.25. Remember, agency, it only costs you 1%. So these are a little bit more expensive when you are putting in your costs. Really love fixed bridge. Now, if you've been around for a little while, you've seen and heard about adjustable bridges, and I'm not going to take too much time on this. This is based on the SOFR, which is your short-term Fed funds. This is what Jerome Powell is telling us. He can't drop it. These started out at 0.5. I own a property that started at 0.5, and now it's 9.5%. I'm paying a large amount of more money on my mortgage. And that's why, because I use the adjustable bridge. Okay. We can do it on big assets, but you have to be very cautious. The other thing about this is that you have to buy a rate cap, and rate caps are extremely expensive. This is like an insurance policy. Remember, when you go out and buy a car, they want to make sure that you're covered. Same thing with the bridge loans, adjustable bridge loans. So in this example, I'm taking on a $20 million loan and my policy is for 2 points. So I'm buying it today at 5.5. That's the SOFR. If the SOFR goes up 2% to 7.5, I have to pay the mortgage. I have to take that risk. Once it goes over 2%, then my policy kicks in, like a deductible, let's call it. This deductible is gonna, if people didn't take these out, they're in distress situations. So moving forward, these are about 3% of the loan amount in addition. So who has in this case, 1.189, who's got that kind of money to be buying an insurance policy for the loan? You also have to buy insurance for the property. So needless to say, it's a tough one. Last thing is bank financing. Lots of options here. Remember, I'm a broker, so I can open up my trench coat and I can go to all different banks, regional, local, credit unions, national banks. We start at $1 million. These are typically a 5-year loan. Rates are right around 7. And if it's on the Wall Street Journal Prime, you're usually at 850 or a 0.5 point up to 9. Okay. You can get a little better leverage, 70 to 75%, and they'll roll in some rehab. But here's the key. Remember, recourse loan. This is a 25-year amortization. So your payments are much higher than what you're going to get on the agency side. Origination is 1%, but as a broker and I help you, we're going to find solutions for you. We also ask for a 1% payment. The prepayment penalties, they vary, but I would tell you most are 0 on bank financing. Okay. So make sure the biggest thing I want to deliver here is make sure you understand who your partners are. If you're getting on you've got the guidelines now, you understand you're going to get a PFS, personal financial statement, fill it out, and now you're going to find out who you need. When you go out into these meetups and conferences, you're going to start to find who your partner is. You need to know them pretty well. I have a partner that has screwed me. So I highly recommend, and I knew him for 8 years. People get crazy when it comes to money. So you really need to know who your partners are. And if you're on the passive side, know who you're investing with. Okay. Have you talked to the operator himself? Or are you coming through a capital raiser? How much is that capital raiser getting paid for bringing in your money, right? What are their responsibilities? How much money are they putting into the deal? Ask the questions, super important. So again, Warren Buffett, who's been around for 100 years, is saying, are you ready? Are you ready to not be fearful when others are greedy? Or are you greedy when others are fearful? The time is now. The opportunities are now. But the only way you're going to get moving forward is 2 things. One, you need to know your roadmap. You have to have the right partners, but you also have to make sure you're putting the right financing with that opportunity. So that's all I have for you. Here's my contact information. Would love to have a conversation. Come join me at the Zoom at 8, and you do that through dancinginvestments.com every Tuesday night. Been there for 5 years. Would love to have you join us. Are there any questions? Let's open up the room.
You guys can come off mute too. You don't have to put it in the chat.
Yeah.
That was a great presentation.
Right.
A lot of good data.
Right.
Well, I'll ask, and no, thank you again, Julie. It definitely opened some light, and a couple things that I myself didn't know is from your end on the lender side is what's something that you're seeing a lot from operators when they're sending some underwriting through that, I don't want to say they're no-nos, but what are some things we can do to make your life easier to help make our life easier as well that you've seen?
Well, yeah, I think there's a lot of that, right? So as new investors and new underwriters, you're making some assumptions. So payroll has gone up. So I would be underwriting, and depends on the area, right? But between 800 and 1800. It's a wide range, but it's no longer 500 to 600. So look at your payroll, look at your property management. If it's a large 100 unit, you're at 3%, 3.5%. If you're into smaller deals, it's going to be 5 to 8%. And usually what we do, if we see it as 8, we'll reduce it to 5 and we'll bring in payroll. And because payroll really affects it, it's a little bit easier how we underwrite it that way. The other thing that I'm seeing is we're going to want to know who's your sponsor when you come to us with an LOI. If you say, I don't know, well, you need to be starting to think about that. So you might not have it at day one, and I have sponsors, and I am a sponsor. So if there's an opportunity where we can work together as a sponsor, or I can find you help, I'm a great asset for you. So that's one thing. That's why you would bring the opportunity to me. The other thing that you want to be thinking about is there's a lot of deferred maintenance on these deals right now. So you need to get more reserves. Okay. These operators are dying right now. They're really, really suffering. Now, if a guy has been in an asset since 2011, he's done a great job. He can give a little bit. He can push over some reductions in prices. But if you're going for a deal that they got in 2022, they do not have any way to negotiate really or give you more money. So I would really be thinking about that deferred maintenance. It's been coming up a lot of times. One of my clients got a reduction in price of 190, and they agreed to it. Now the bank is saying, I need 200,000, an additional 200,000 to be put in and for improvements, and they need to be completed in the next year. So we're going back and asking the owner to see if he can give us a reduction in price, but it's tough. These agency is saying, I'm not going to put up with this. We have to fix these assets. We need to make, especially on agency, we need to make the American people living in healthy apartments. We provide the debt. We want to provide housing for them. So it's really, really important you look at your reserve accounts. We are cutting proceeds. We've seen a lot of that. As I mentioned, 6570 is about where it's underwriting. We're seeing a lot more economic vacancy. That's your bad debt, your vacancy, right? And loss to lease. That is huge right now. We like to be around 15% max, but we're seeing 20, 22%. So there's going to be a reduction in price. There's also a conversation. What happened here? What's going on? And we're going to ask that right up front to say, you know, please help us understand this. Okay. So that's going to be why we're going to be cutting proceeds. Buy downs are another strategy that a lot of people are. You can buy down 20, 30 basis points. So if I'm at 625, now you're below 5%. I'm sorry, below 6%, in the 595 range. So buying down is going to cost you about 2% of the loan amount. So you'd pay the origination of 1, and if you want to buy down, you'd pay 2. But it might be the right strategy. Remember, we all need to understand what the business plan is of these assets. Yeah, you're on mute, Joe.
Oh, so I love it. I mean, that's really good. It's really good session so far. Do you are you guys loaning out for hotels at all?
Oh yeah, hotels, homes, like build to rent. Yeah, we do it all.
Awesome. This is a
Awesome.
great session. Thank
Well, we
you so
appreciate
much.
your time. I know you're kind of stuck for time and got to head out for your
Yeah.
meetup. So again, I
Yep.
appreciate you. Thank you for giving us some valuable nuggets. I myself will be reaching out to you for sure on a little bit more guidance. So just thank you again for your time, and everybody else. We're gonna be heading back to the breakout room. We've got some networking and shameless plugs going on. So see you guys soon.
Great. Thank you so much for the opportunity, Winston. I appreciate it.
Absolutely.
Bye-bye.